So let's talk about the accounts receivable. So when goods or services are sold to a customer and the customer is allowed to pay at a later date, this is known as selling on credit and creates a liability for the customer to pay the seller. Conversely, this creates an asset for the seller, which is called accounts receivable. This is considered a short-term asset since the seller is normally paid in less than 1 year. So there are three major classes of receivables. The first one, which is in the general situation, is accounts receivable due 30 days. And the second one is notes receivable due 30 to 90 days. And the last one is other receivables. So there are three primary accounting problems associated with accounts receivable. The first one, recognize accounts receivable, and then value the accounts receivable. And the final step is to dispose of the accounts receivable. So let's talk about the first step. We know when a business sells merchandise to a customer on credit, the accounts receivable is debited and the sales is credited. And then we need to value accounts receivable. To ensure that receivables are not overstated, they are stated at their net realizable value. Net realizable value is the net amount expected to be received in cash and excludes amounts that the company estimates it will not be able to collect. And the final step is to dispose accounts receivable. To accelerate the receipt of cash from receivables, owners frequently sell to a factor, such as a finance company or a bank, and make credit card sales. So, above all, that's the brief description of accounts receivable.